What happened on Friday, and what do you think is going to happen this week at this point?
It's interesting. I've been thinking about this over the weekend. As we know with the Fed, they're waiting for three things to happen before essentially waving the flag. That is, either we're going to see employment or unemployment reach some level that is intolerable. That obviously didn't happen with the jobs number. Either we're going to see a major contraction in the economy, which obviously that didn't happen last quarter with a 2.6% expansion, or we're going to see the inflation numbers come down. Right? Those are the three triggers that we're waiting for to see the Fed rethink its path. They've been surprisingly all saying the same thing for the last few months. I think after July, when Powell word vomited on himself, they had to come to Jesus about their messaging if they're going to forecast what they're going to do. But the interesting thing coming out of this earnings season is that the consumer is thinking about the state of the economy very differently than the businesses and the banks. And so coming in, even though the expectations decreased dramatically, remember we went from a 10% earnings growth expectation that by the end of the third quarter, a 2% earnings growth expectation. We didn't have the average number of beats, but the consumer spending, when we heard the CEOs talk about consumer spending, especially restaurants, airlines, Booking.com, OpenTable, the consumer's still spending while the banks are provisioning and while the companies are talking about layoffs, they're talking about deceleration, or talking about girding in the bunker. And so the consumer's thinking about this a very different way. And I posit that the reason is because all that spending that we're doing is leverage. When you look at the credit card data, we've had record openings the last few quarters. We're approaching $900 billion, which is approaching that record we set in fourth quarter 2019 of $930 billion. And so it'll be interesting to see when the consumer gets the message that the businesses and the banks are sending.
I have to say that I'm not sure I understand, though, which way you're suggesting this economy is really going. You think it's about to turn down? Is that underneath what you're arguing?
I think that it will be less robust than current estimates reflect. And so, yes, if you're asking me which side of that argument I side on, I side with
straight up. I'm trying to ask you what's about to happen here. That's what I'm trying to do.
Yeah, we're going to go into recession. I've been on record with that, Andrew, for about 8 months now. We're headed for a recession. The banks are provisioning because we're heading for a recession. Companies are talking about laying off workers because we're headed for a recession. That's my view.
Downside risk at this point in the equity market, therefore?
I believe so. Right now, if you had to ask me, I'd say flat for next year, which presupposes an S&P of around 3,700. Obviously, there are many extant risks that could make that lower. We don't know how deep the recession will be in Europe and other countries. We don't know what energy pricing is going to look like as we enter the heating season and the embargo begins on Russia. We don't know if we're going to have a sovereign debt crisis with several countries in Europe somewhere above 150% debt to GDP. And so there's lots of outside risks that could make this lower. Right now, if you had to put a gun to my head, I'd say it's probably a flat year next year. Right. Consensus is at 6%, though. So we've got some downward revisions coming. There's not going to be 6% earnings growth next year.
Okay.